Hey, good afternoon, everyone. My name is Jeanmonod, Regional VP of Sales here at Angel Oak Mortgage Solutions. Happy New Year to everyone, although I've heard that after the 3rd, you can't wish everyone a Happy New Year. But we haven't seen a lot of you since then, so Happy New Year. Hope your year is off to a great start. We're going to talk to you today about some programs, some trends that we're seeing already for 2024, and we'll talk to you about how you can market yourself and some great tools that we have to help you price loans, because that's always a question we get. Where do I find rates? Where do I do this? We're going to go through all that here today, and I'll introduce our subject matter experts. I know a lot of you know them because they are the best of the best, and even when I'm on shows on the East Coast, I hear about that West Coast AE out there. We'll introduce him in a minute, but we'll give everyone a chance to log in and get started. This is going to be recorded. We will get this out to you before end of day tomorrow, and if we don't answer all your great questions, we will have your account executive reach out to you to get your question answered. So look forward to it. Give it about another 30 seconds and we'll get going here. Everything we're going to do today is off our website. This is, again, being recorded. At the end of this presentation, there's a quick survey. We'd love to get your feedback, and that kind of plans our webinars going forward. So get started here. Still people logging in. Give it about another 10 seconds. I see some familiar names here, so this is great. All right, let's get started here. 2 minutes after the top of the hour. My name is Jeanmonod, Regional VP of Sales here at Angel Oak Mortgage Solutions, and look forward to having you guys join us here today. I'll start with our West Coast guy, Eric Morgenson. Please introduce yourself.
Hey, John. My name's Eric Morgenson. I'm VP of Business Development out here on the West Coast. Listen, we're here to make you money.
And Eric, I think, are you celebrating an anniversary this month or is it next month? I think it's been how many years?
Next month.
Next month. 10 years?
10 years with Angel Oak, absolutely.
Yeah.
Everything Angel Oak.
And I always say Eric's last name should be Morgenson because he knows everything about mortgages. So, and then someone I get to work with every day who's in the South Florida region, Scott Gruebele. Scott, please introduce yourself.
Good afternoon, everybody. Scott Gruebele. I'm an account executive down here in South Florida, Broward County to be exact. Have been here with Angel Oak since 2016, going on 9 years, and I'm pretty pumped up about this webinar. I think Eric went right to the point. Let's talk about how we can help you make more money in 2024, right? So we're seeing a lot of trends. We're seeing a lot of different opportunities out there in the market. So we're going to talk about them all today and how they can help you all increase your production.
So Eric, before we get into our poll, let's do a poll first. Let's do our poll first. So let's launch our poll here. The poll is, who has originated a non-QM loan in 2023? So while we're going through that, Eric, are you seeing, while everyone's answering some questions, Eric, are you seeing any kind of trends moving in the market over the last, say, quarter to half of 2023?
No question, folks. Listen, what is left in this market? It's the year 2024. It's either hard money or non-agency, non-QM. Guys, that's it. There's no rate and term going on out there. There's no tangible net benefit. So literally, reverse mortgages, with the rates so high, they're not really getting that monthly check that they were hoping for. So what's left out there? It is hard money, private money, I should call it, and non-QM. Now, we have a perfect storm going on right now for this underserved borrower out there that nobody's paying any attention to, and that's what we're going to unpack in this webinar.
Yeah. So let's look at the results of the poll. Okay, wow, we've got some seasoned people over here, so this is great. Usually we average around 70% have not. So here we're saying 48%, almost half of you, have originated a non-QM loan in 2023, which I think is great great news. You know, Eric, to add to what you said, you know, the MBA is forecasting 2.5 trillion in originations in 2025, but only 7% of that, Eric, is going to be refinances. So, you know, which is basically continue flat from 2024. So we're going to share some tidbits of other intel that we have. But Eric, let's go into some of our programs here. And Eric, I'm going to have you start with our bank statement. Oh, sorry. I'll put my glasses on here. With our bank statement program, Eric.
Certainly. Alt income or bank statement loans are again, there's that borrower out there that is taking advantage of our 75,000 page tax code here in the United States. Literally, you have W-2 wage earners, and then you have self-employed. Completely different set of tax codes. Now, with that said, never before in the history of mortgage banking can a self-employed borrower document, I don't know, $36,000 in personal income to the IRS and turn around and buy a $2 million home at 90% loan to value, utilizing just what he's depositing either in his personal or in his business checking account. Now, here's the crazy thing. Who has a database of self-employed clients that are currently making a ton of money, but not really documenting a lot of money to the IRS, and they're currently renting? Who has this database? Guess who has it? It's your CPA is sitting on that database. But CPAs really don't know about these bank statement loans or the fact that they even exist. That is an enormous opportunity right there that is being missed every day.
Yeah, Eric, it's funny. I was at a function about 6 months ago, and there was a financial planner there, CPA, also had her origination license, and I asked her, do you know of anything about bank statement loans? Never heard of it, Eric. Never, ever heard of it. So
opportunity.
Yeah, and the opportunity is only growing, Eric. So I always throw out there, you know, in 2020, right after COVID, 2020, new business applications grew by 24.7% over 2019. That was the largest increase in new business applications in over 10 years. 2021 saw new business applications grow by 22% over 2020, and that trend's not slowing down. So this is the largest segment of new Eric, you use this word, the giga economy. It's the self-employed borrowers larger than the opportunity for VA borrowers. So Eric, I don't know if there's anything else you want to talk about. Bank statements, just the opportunity, business, personal, just jump in a few.
I do want to address something regarding bank statement loans, you guys. For the folks out there that have been doing bank statement loans, you know that literally 10 years ago, before the CFPB even delineated what is a qualified and a non-qualified mortgage, Angel Oak had been doing bank statement loans. Now, bank statement loans years and years ago were wonky. They were hard. Literally there was a big swing and a miss on a lot of them. But over the last 10 years that Angel Oak has been doing bank statement loans, we've had about 11 different renditions on how we calculate a self-employed borrower's income and document, obviously, the ability to repay, the ATR regulation. That's very important in this lane. You see, every borrower has a 3-year statute of limitation to sue their lender, and that's Angel Oak in this arrangement, for their inability to repay their primary mortgage. They have a 3-year statute of limitation. So if we calculate income and maybe use a tax refund check and use that as income for the borrower, that borrower has literally a possible case of ATR violation. So bank statement loans were wonky, but right now, Angel Oak, we have this down to a science. Often, same day, we get back to you with a full income and credit underwrite right up front. Even before you disclose, even on a TBD property, we're giving you full income and credit underwrites. That makes it a lot easier for you and your referral partners out there, because we're giving you and your referral partner exactly what kind of purchasing power that borrower has. How much of a house can they really afford? And Going bank statements, you would be surprised on how liberal we are on income.
Yeah, Eric, 67% of the loans we close here at Angel Oak are, volume-wise, are actually bank statement loans. So that's a huge portion of our business. And then, there's obviously between business and personal. Scotty, anything to add regarding, obviously some features and functionality of our bank statement program?
Absolutely. I think there's, and to kind of, it seems like we have a pretty experienced group on this call. High percentage of you guys have funded a non-QM loan already. So, I mean, let's face it, you guys know what a bank statement loan is, you know what a DSCR loan is, you know most of the non-QM products and programs, but there's a lot of little niches and nuances within the programs that maybe you're not aware of. And I think these are opportunities for us to discuss because you can leverage them going into 2024 to generate some volume. And kind of taking a little bit of a step back because, the topic of this call is, trends for 2024 in the non-QM space. And I kind of want to just take a peek at 2023 real quick, because I think what we saw was something unique in the space. While we all know volume was down in every space, the one thing we did see is a pretty strong expansion of products, programs, and guidelines in non-QM. We saw the introduction of the P&L program. We saw expansions to the DSCR program. We saw some lenders expand into 5 to 8 units. We saw closed-end second mortgages got introduced, right? We rolled out an 85% LTV DSCR right at the end of the year. So we kind of laid the foundation, so to speak, of having a little bit more tools available to us going into 2024. And I think that, presents a huge opportunity for everybody on this call to leverage them and build on them. As we all know, we're expecting 2024 to be an environment where interest rates are going to trickle down. We've seen that already. I was taking a look at our rate sheets and our matrices going back to where we kind of peaked out towards the end of the year in 2023. And in some buckets, our rates have come down already almost 1.75% to rate. So it's significant. And I think what we're going to see is the opportunity for being able to revisit any originator on this call who has closed a non-QM loan in the past. I think you guys will have the opportunity to revisit those borrowers, potentially for some debt consolidation or cash out refinances. And then obviously we have all of those buyers that have been sitting on the sidelines in this rising rate environment, waiting for rates to come back to a point where they feel comfortable stepping into the market. If we kind of pivot back, John and Eric, and you guys remember this, to like 2022, towards the middle of 2022, where we were still seeing volume grow significantly. Non-QM was really leading the way from a volume standpoint. And I think a lot of originators on this call will attest to a lot of those big jumbo loans we were seeing. Those were bank statement borrowers. Those were self-employed business owners that were buying those higher priced properties. And we kind of saw them come out of the market completely in 23. We also had a ton of investors buying more investment properties, both short-term and long-term rentals. Airbnb, VRBO businesses were blowing up. I think we could see, revisit those. And obviously those are an opportunity for refinance. So, going into 2024, I'm personally extremely optimistic. John, you threw out some of those numbers from MBA. Projections have the non-QM space to be anywhere between, I made a note here, 4% of overall mortgage origination volume. I'd like to be a little more conservative. I say if we cut that in half and we go to 2%, based on the 1.9 trillion that's projected by the MBA of overall volume in the space, in the mortgage industry for 2024, we're looking at about 38 billion in the non-QM space. So guys, we're talking a massive year-over-year growth from 23 to 24. That's the opportunity that's in front of us in 2024. Back to how Eric opened up, that's where we can help you make more money, leveraging all these products and programs and expansions that we've done to them to originate that volume.
Yeah, Scotty, and all our account executives share, how you with self-employed borrowers and bank statement borrowers, how you increase that buyer's purchasing power, right? It's 2, 3, 4 times. Our average loan amount across the entire program assortment that we have is in the high 400s. When you talk about bank statements, specifically business bank statements, you're talking $740,000, $750,000 because it's that self-employed borrower that's purchasing those luxury homes. It's not W-2 John Q W-2 borrower buying those, right? So, you're looking at, everyone says they're harder to do. They're really not harder to do. It's just a different channel you have to use outside your normal channels of Fannie, Freddie, FHA, USDA. And I just think, and as Eric mentioned, we've made it really, really easy. We calculate that income for you up front. We'll do them on TBDs, as Eric said. So go ahead, Scotty.
I've always argued that it's easier. In my opinion, a bank statement loan is easier than a full doc loan. And that's, coming from, as you all know, we do full doc loans both on the non-QM side, and we offer some agency business as well. And we did a lot of agency business in 2020. And so I have got the unique perspective of having done both in volume. And I think a bank statement loan is much easier to originate because we're calculating that income up front, like Eric mentioned. So we know before that loan is submitted to underwriting, we know what the income is. We don't have to worry that an underwriter still has to run an income calculation, and they may look at the tax returns a little bit differently, and you're going to come up with a completely different income. They may come up with a different income than what the originator did, and now we have a problem, right? We don't experience that. The income is done on the bank statement loan when it goes in. And so, kind of to dial it in a little bit, again, everybody on this call has originated, mostly everybody has originated non-QM loans. So let's talk about like some of the little niches within the bank statement program that I think can help people out. I think very underutilized, but keep in mind and remember that on our bank statement program, we allow you to combine both bank statement income and W-2 income. That gets forgotten a lot. I still get that question a lot. So if you have 2 borrowers applying, one is self-employed, one is a W-2 wage earner, we can combine the income from both to qualify that borrower. In some cases, the borrower that's self-employed also has W-2 income, and we can utilize that W-2 income. Maybe they have some Social Security income as well. We can add that in there and get them qualified as well. We have some self-employed borrowers who own multiple businesses. They might own 2 businesses that they derive income from. We can use both of those businesses to qualify. Your Schedule C borrowers, I get this question a lot. Borrowers doesn't own a business, it's not incorporated, they're not 1099, they file a Schedule C. What can we do, Scott? We have a personal bank statement program we can use for those borrowers. So there's a lot of flexibility within the program, and I think some of those things can be used to market them. The other part that I think is, the other feature I should say, that I think is really underutilized is the interest-only feature. Eric, I mean, do you see a lot of them being used out there on the West Coast?
Yep, absolutely. Self-employed people, cash is king, cash flow is king, and for them to have a choice to make only an IO payment versus principal and interest is very compelling to them.
Yeah, and so if, for bank statement borrowers, especially if they're buying those higher priced properties, I know personally a lot of the self-employed borrowers I know and I've worked with, they want that flexibility, like you said, Eric, of having that lower monthly payment on an interest only, and then they can just whack down the principal whenever they feel comfortable, whenever their business has had a good month, right? So that's a feature that I think is not used enough. And now let's take that into investment properties. If you're an investor, what is your number one goal? Cash flow, monthly cash flow on that property. Well, what better way to do that than having an interest-only payment on that property? So I think that's another feature that's underutilized. I'd also like to bring up, we allow waiver of escrows on our loans at 80% LTV and below, and we do not charge to waive escrows. So I think that's another big feature and little niche that everybody on this call can use to kind of help sell these products a little more.
So, yeah, so already some questions coming in, and we've had a lot of people jump on even after we started. So I do want to make a couple of, for lack of a better word, housekeeping comments here. This is being recorded. We will send out a recording of this by end of day tomorrow. And if we don't get to a lot of great questions already coming in, we will have your account executive reach out. I will answer Robin's questions here. She's asking, do we have a PowerPoint presentation we can use with our external partners to present? Robin, we're going to get to that. That's our marketing portal, and we're going to talk about that because I believe that is one of the most powerful presentations, educating not only the originators out there, but educating your referral source is key. And you know, we've been committed to doing this for a decade, but I've seen a lot more people take us up on this over the last 12 to 18, 24 months. So I would, if I'm you on this call, I'm making this part of my 2024 marketing and infiltration plan into your referral sources. Scott, while you were talking about IO, Dave has a question here. How do they qualify? Do they qualify off the IO payment, or do they qualify off the fully amortized payment?
They qualify off the fully amortized payment for qualification purposes, but then have the benefit of taking advantage of the lower monthly payment.
Yeah.
On a DSCR loan, we do qualify the debt service coverage ratio off of the IO payment.
Exactly. I said we should add that asterisk. However, on the DSCR loan, we do allow you to qualify the DSCR ratio off the interest-only payment, correct?
And we're going to get here with the DSCR here in a minute, but that's a great point, Eric. But, you know, the IO works interest only for the first 10 years, then converts to a 30-year fully amortized loan. So, you know, and as Scott said, you know, any payment towards interest reduces principal. So, Eric, before we get off of bank statements and go to our debt service coverage ratio program, Eric, anything else that you're seeing in your marketplace that, you know, bank statements?
What I want to talk about is the opportunity for the people on this call who are originating loans right now. There is much reason to be bullish about 2024. And here's why. We have another perfect storm. Never before in the history of this country have we had so much equity in residential real estate. Never before in the history of this country do we have all-time high consumer debt, all-time high car loans, all-time high student loans, all-time high credit card debt. Never before in the history of this of mortgage banking do you have such a low first mortgage interest rate. But you have people sitting on a ton of equity, and boy, wouldn't they like to get to it, but the last thing they want to do is disrupt that 3% first mortgage rate. We have an alternative income bank statement second mortgage. It's ideal for literally debt consolidation, pulling some equity out of their house and paying off that, you know, 24 to 29% interest rate credit card debt, paying off that 12.5% interest rate student loan, to paying off, you know, subprime car loans are at 38% interest. So it makes perfect sense to pull some equity out and literally pay off some debt. Folks, nobody's really paying attention to these borrowers out there. Getting the word out, that's where we need your help, and we have the marketing to do so. But folks, you can absolutely get rich on the niche in 2024. We have niches inside of niche programs here, and we will take you by the hand and walk you through these opportunities. Just reach out to your Angel Oak AE.
Yeah, Eric, so I agree with you 1000%. You know, when you look at our closed-end second, and we just rolled out HELOCs, we're going to be rolling out bank statements for HELOCs probably in a couple of weeks. But like you said, you know, you could create your own little, like you said, your niche. When you do a closed-end second or a HELOC, you're taking seller out of it. You're taking seller's agent out of it. You're taking the buyer's agent out of it. You're taking all these other outside forces, and you're creating your own little path to originating second leads. So let's go on and get, were you going to say something, Scotty?
Oh yeah, I was just going to add on to you guys, because I think this is a huge opportunity for everybody on this call for 2024. Eric nailed it on the head. So everything Eric mentioned, facts. We all know that. Everybody on this call knows that. Facts, okay? So something has to give. So I really feel like one of the bigger opportunities this year for an originator is in their book of business. We can't control when buyers decide the rate's low enough for me to come out and start buying the property, right? But you guys can control staying in contact with your book of business. If you guys look back at how many loans you originated in 2020, 2021, and 2022 at such low interest rates, as I mentioned earlier, those borrowers, based on the facts Eric just gave us, the majority of them are in need. They're in financial need. They need to possibly consolidate. They need to possibly get out from under that high interest debt. So now with the closed-end second mortgage, we obviously know about a refi, right? Everybody knows about debt consolidation refi, but a lot of them are not going to want to let go of that first mortgage and that rate that they have on it, as Eric mentioned. So the closed-end second is the way to do it. And guys, we do the closed-end second mortgage on the bank statement program. It doesn't have to be a full doc. We can qualify them on bank statements. It goes up to an 85 CLTV and a 500,000 loan amount. So we're talking significant loans. These aren't, $80,000, $100,000 loans here. Right. You're talking, borrowers that have a ton of equity that be able to tap into 400 or 500 grand and go up to that 85 CLTV. So huge opportunity there, right within your own book of business.
Yeah, and Eric,
there's never any. Real quick, there's never any prepayment penalty on these bank statement seconds or on our second TD programs. Even if it's an investment property, there is no prepay penalty whatsoever. And going lender or borrower paid comp, Angel Oak, with borrower paid comp, we don't claw back your broker check. Other lenders, even borrower paid comp, if that loan, pays off inside of an EPD or early payoff demand, literally they're clawing back your broker check. At Angel Oak on borrower paid comp, we do not.
Yeah, and Eric threw out, all-time credit card debt, the average interest rate we're over $1 trillion right now in interest card debt is 27.8% is the average interest rate. 2022, Americans paid over $120 billion in fees and credit card interest in 20. And who knows what that number is going to look like in 2023? It's got to be close to $200 billion in just interest and credit card fees. So, I mean, there's a lot of people, like Scotty said, there's a lot of people out there that need your help. Reach out to your former customers and see what we could do to help them. We have a market, and we're going to get to that.
Self-employed borrowers, they understand the tax code a little bit better. Understand if they pull equity out of their residential property, yep, that we have the mortgage tax deduction in this country. The only industrialized nation that you can write off the interest on your mortgage. Can't do it in China. Can't do it in Japan, can't do it in Australia, can't do it in England, can't do it in Germany, can't do it in Canada. We're the only country. However, if you're self-employed and you pull equity out of your residential real estate for business purpose, that interest is 100% tax deductible. That's very important to self-employed people who might want to access some capital in order to buy inventory or to apply towards their business. Folks, we need your help getting the word out about these programs so these self-employed Americans can take advantage of this.
More facts.
Yeah.
More facts.
Well, but they are, we're not joking about it, but they are facts. And I think if you're going to make your 2024 successful, you have to start working on those now. I mean, if you're yes, there's talk about rates being reduced, maybe March, April. They're not enough. They're not going to reduce rates enough to make people refinance. 85% of the people in the U.S. have a rate of less than 6%. 63% have a rate of between 2.5% and 4%. So it's going to take a while before those people move off that. So look at second liens. Look at expanding your world by looking for that self-employed borrower who's been, as Eric said, and as we have on the front of our website, on the homepage, the underserved borrower. So I know
guys,
go ahead.
we were closing in 2022, 2021 into 2021. We were closing DSCR loans in the fours. I mean, bank statement loans in the low fours. It was stupid how low the rates were. Okay, so that borrower doesn't want to touch that rate. We get it, but the closed-end second, man, what an opportunity. And just so, because I know it might be a question that popped in already, we do closed-end seconds on investment property, second homes, and primary. So you can do it on all three. So even if you did a DSCR loan back then, you can go back and help that borrower tap into that equity and pull some cash. I mean,
yeah, so I want to make sure Travis was asking that question around investment properties on HELOCs. Right now, HELOCs are just primaries, but as Scott mentioned, closed-end second loans can be done on investment properties. So Scott, give us some, we're half past the hour. Scott, let's talk about DSCR loans, which is our second most popular program, and probably unit-wise, very, very close to bank statements when it comes to units, but obviously those are a little less loan amounts.
Massive. So everybody on this call, I'm sure, is familiar with the product. DSCR loan for investment property only, no income verification, no employment verification, no ratios are required. So this program has really grown a lot in the last 18 months. And I'll start with the most recent change. The most recent change is we're now going up to an 85% loan to value on the DSCR loan. So I think we're going to see some properties that can fall into that bucket. But let's go down the LTV scale. We go to old school was 80% max LTV. We're still doing the 80% max LTV. And then from there, we start to see some options really open up. At 80 and 85 LTV, we need a DSCR of 100. It's pretty straightforward. However, if you go under 80% LTV, if you go to a 75% LTV, you can go down to a 0.80 on your DSCR, meaning your rent can be up to 20% less than what the PITIA is on that property, okay? And then if we go down one step further and we go to 70% LTV, guess what? We can waive the DSCR requirement altogether. That's correct. Doesn't matter what the rent comes in at, doesn't matter the difference between rent to payment, we're waiving it all together at a 70% loan to value. We're one of the few, if not only, lenders that still has that option available to the market. What are the other niches we see? Closing in an LLC, and now we allow closing in a corp on a DSCR loan for an investment property. So we've added some more flexibility there. We've always offered foreign nationals under the DSCR program. I think we offer one of the easiest foreign national features out there. It's pretty cut and dry. DSCR needs to be 1-to-1. Your borrower needs 30% down and 12 months reserves. That's it. Call it a day. Don't need anything else. Nothing from the country. No credit. No income. No letters. Nothing. That's it. 12 months reserves.
And let them know reserves. They can keep that money in their country of origin and not have to transfer it to a U.S. bank. That's extremely important.
Yep, in their country. Exactly. We've increased loan amounts on this program because obviously we know that the short-term rental market has really taken off, and we have a lot of those investors that have purchased higher priced properties that they generate a lot of rental on. So we can go up to 3 million loan amount now on the DSCR program, and on the low side, we can go down as low as 100,000. Another one that's big and applies not only to DSCR, but to all of our programs, and I see a lot of it here down in my market. I know Eric sees some of it out there, non-warrantable condos, okay? Yeah. So in the state of Florida, I can speak for, we're up to, I think, 70 some odd % of buildings in the state of Florida are now deemed non-warrantable condos. They are not eligible for financing from Fannie or Freddie. They have only one other option, non-QM. And so if that's an investment property, we can do non-warrantable condos on our DSCR program. We go up to 100% investor concentration. We allow up to 10% deductible on insurance. We can go up to 15% deductible on wind, hail, AKA hurricane insurance. And there's a lot of other features from, reserve standpoint that we allow, and the way that we calculate reserves. We're not looking at just the current year's budget. We're also looking at what they have set aside from previous year's collections, and we're adding those numbers to meet our reserve requirement. So a ton of flexibility added there. So like I said, there was a lot of growth to the DSCR program over the last 18 months. I think I covered it all. I'll throw in 2 extras. Non-permanent residents are allowed on this program, and condotels are also allowed on the DSCR program.
And also, when it comes to non-mortgable condos, we're double the entire market with single owner concentration at 20%. The market out there stops at 10%.
Yeah, Eric, and there was a question here from Carla Scotty just regarding, she didn't want to get into the weeds, but I think it's a good question. For a foreign national, how do we keep from money laundering? And obviously, the money has to be in an FDI insured bank. Sourcing season for 60 days, 30 days here in the U.S. So hopefully, Carla, that answers your question. So a lot of great questions, and hopefully we'll get your AE asking answers to those questions. So a couple other things. Let's go. I know we have full doc. I think, Eric, if you want to just touch basically on the high level of full docs, and we'll get into more of our marketing and how to submit a pre-qual.
Okay, full doc. Let's talk about it. Again, a completely underserved set of borrowers out there that Angel Oak can do a loan one day out of a Chapter 13 bankruptcy. Now think about it. COVID forced a lot of self-employed people into bankruptcy because the government shut down their business. Well, guess what? Those folks are all just now being discharged for their bankruptcy, but they're sitting on a ton of equity in their residential property, but they can't access any of that equity because everybody's giving them the Heisman Trophy stiff arm that, no, you've had a bankruptcy. We're not going to let you, we can't do a loan for you for 4 years. At Angel Oak, we can do a cash out one day out of a Chapter 13 if they filed for that bankruptcy at least 24 months ago. Guys, there's millions of borrowers that no doubt would want to access some of that equity right out of a bankruptcy. Why? Listen, if you're going through a bankruptcy, you're making these payments. A judge makes you literally have a payment plan. You pay everybody back, but I'm sure those borrowers have been probably eating top ramen and watching Netflix on Saturday nights, really didn't have a lot of cash flow, but they're sitting on a boatload of equity. Let's let them tap into the equity of their property and do whatever it is what they want to do with it, especially if they're self-employed. I'm sure they're looking for capital for their business. Folks, again, a completely ignored set of borrowers out there that we want to help you get to. And we do have marketing that is focused on these wonderful niches.
Yep, this is one that I think is underutilized as well. Again, another opportunity for the new year for an originator, because I still get the question from a lot of experienced originators sometimes, you guys do full doc? Yeah, we offer we have basically 3 different full doc programs. And at the end of the day, why would you send a loan to us full doc? Simple, they don't qualify conventional. You're not getting that approved eligible, so if you can't get that there, call us. We have 3 different programs where we can fit it into. We can go full doc investment property, close in an LLC, close in a corp. We offer the interest only feature on our full doc programs. As Eric mentioned, we have the seasoning for Chapter 13 bankruptcy, one day out. We have a foreclosure, 1 year out of foreclosure on full doc loans. So a lot of flexibility. And a big one that I'd like to mention is if you have a self-employed borrower going full doc, you want to go 1 year tax return, we offer that ability with only 2 years of self-employment. On the agency side, of course, you need 5. You only need 2 years of self-employment to use a 1 year tax return program with us.
Which, Scotty, is great because we talked about those statistics of how much the self-employed borrower has grown since 2020. That's a great point. That person still today cannot go full doc as a self-employed borrower because they don't have that 5 years. And why not? Everyone has their own opinions. Now, a great time to buy a house. I think any time is a great time to buy a house. So why wait? But Eric, you mentioned about equity in homes. Since 2019, homes have appreciated across the country. I'm sure there's different pockets that have increased. 2019, the average home has appreciated 47.5%. That's, you talk about that equity, let alone the mortgage that they're paying down. So I know we're 20
Perfect
minutes.
storm, folks. This is a perfect storm. Meanwhile, now, a lot of you folks that are listening to this are probably going to take action and start executing on what you're learning right here, but most of you aren't. That's the reality of it. And with that said, it's amazing on how many people became millionaires during the Great Depression. Unbelievable. How about the people that became millionaires during the financial meltdown of 2008? Now, there's going to be a lot of loan originators out there that are going to absolutely thrive in 2024 by going after the underserved market out there. It is just waiting for you, but you got to take action.
Yeah, Eric, I was listening to someone on a podcast or a webinar the other day. Some of the wins last year may not show up to this year. And I think some of your wins, for the rest of the year, your first quarter hard work might not show up right away, but don't stop. I mean, it's probably going to show up in maybe Q3 and Q4. So, and Eric, I get worked up with what you just said. Some of you will walk away from this call and, not do anything. And hopefully more of you will walk away from this call and say, you know what, it's time for me to change. It's time for me to market myself outside my normal channels. So Scotty,
John, if I may, folks out there, we're here to take you by the hand and walk you all the way through this. We have the marketing. We have the programs that match this perfect market storm. You guys, we will show you the way step by step. Just lean on us and we'll do the lifting. Folks, we're in the service business, and that's the fun part about what we do. We're in the service business and we're here to make you money because my CEO, my underwriters, even our accounting staff, we don't make a penny unless your loan funds. So we are truly vested in making your deals work. In Angel Oak, as of lately, we've become very aggressive in our guides. We allow 50% DTI front and back end. We literally get very creative on making your loans work if they're workable. Give us a chance.
Yeah, and Eric, as we continue to see how these loans perform over the last decade, and even through some peaks and valleys, they still continue to perform because these are great borrowers, great credit scores, great assets, hard-working, self-employed people. They continue to perform. Scotty, we briefly touched on seconds. I don't want to spend too much time here because I want to show everyone how to submit a pre-qual, and then we'll talk about the marketing portal. Go ahead, Scotty.
All right, the closed-end second mortgage. We went over this. I think we covered the majority of it, but just to touch on a couple of the other highlights. 500,000 is the max loan amount, but you can go as low as 75. I mentioned 85% is the CLTV. Here's a really cool feature. It's a closed-end second, guys. So this is going to originate, close, and fund just like any other first mortgage you do. And then the borrower is locked in to that payment and interest rate. Your borrower is getting a lump sum of cash in their hand at the closing table, just like a cash out refi, only they're not touching that first mortgage, okay? Now, you have some flexibility in terms of your terms. You can go 30-year, or they could go 20, 15, or even 10-year if they choose. A lot of times when they're taking out that second mortgage and they're just, piggybacking on that first, they may not want to go to a full 30-year amortization, so you have the options to do that. I mentioned earlier that you can do these on your primaries, second homes, and investments. And I mentioned earlier that you can do these on single family, PUDs, and 2-unit property. So if you have investment properties, multi-unit, you can do them. Business or personal bank statements can be used to qualify these borrowers. So again, going back to what I feel is an opportunity for you all, write in your book of business. And if I'm an originator, I'm going to my book of business and I'm having a conversation with anybody that I closed a bank statement loan for from 2020 to the end of 2022, because I know they are all locked in to low interest rates on that first mortgage, but a majority of them, as we mentioned, might want to tap into that equity. So huge opportunity there. Anybody I closed a DSCR loan for in that same period of time, I'm reaching out to them to have a conversation to see if I can qualify them to tap into some of that equity using bank statements or going full doc. 50% is the DTI on the closed-end second mortgages, and I think that covers most of it.
Yep. So while you're talking to Scotty, let's go. So this is all from our website. I'm going to go to our homepage. Scott, just tell us how, we've talked about our programs. We talked about, our commitment to help everyone grow their business. So let's get down to the bread and butter of, or the nuts and bolts of how do I get rates? How do I get you, Scott and Eric, and all of our other great account executives in the country? How do I get you a pre-qual?
Yeah, so real simple. This is our homepage, angeloakms.com. You're going to head over and tap on non-QM quick quote.
Yep.
That's going to take you to our pricing engine. If anybody on this call has done this numerous times, just go over it real quick again. We've added that lien position drop down where you can select first lien, or if this is a second mortgage, you would select second lien there. So first lien, standard mortgage, second lien is going to be for our closed-end second program. And then you'll just start to input the data for the loan scenario. You'll see pricing will start to pop up at the bottom. And then once John finishes up selecting the product or program we're using here,
A lot of pressure.
yeah, you'll see the pricing. There you go. So this will always organize the programs this borrower qualifies for in order of best rate. And then if you click on that view rate button, which you want to make sure you do, you'll see your entire full pricing stack with all of your options. So assuming you wanted to submit a pre-qual to your account executive, you would select a rate, click the next button down at the bottom.
Now, if you select that rate, you're not locked into that rate, just so this is just for pre-qual purposes, just so.
That's just telling me, the account executive, this is the rate that I'd like you to price this scenario up for me on. So here on page 2, if you have a 3.4 file buttoned up, you could drop it in. Majority of times you probably don't, so you'll just hit next. And then in page 3, you're going to fill out some basic information, select your AE, your company name, your name, NMLS, etc. And then here at the bottom, you can drag and drop all of the documentation securely into these buckets, your 1003, credit report, bank statements, etc. Get down to the bottom, answer a few questions regarding credit, and then you'll submit this, and this will come directly to your account executive.
Yeah, Scotty, so I know we didn't answer a question. The majority of the loans we close on bank statements are usually 12-month, but I mean, why would you suggest someone get you all 24?
Because it's better for us to see the bigger picture and determine which one makes the most sense for the borrower. There are certain
Go ahead.
I was going to say there are certain LTVs where 24 months may price better, but I always recommend to my originators to get the 24, just get it up front. We're going to calculate both the 24 and the 12 for you. And then now we have options. We can look at both and see which one makes the most sense for that borrower.
Yeah, and again, we're calculating that income for you. We're not asking you to do any work. And I would tell you, I usually say this as a public service announcement. If you know in advance you are working with a self-employed borrower, yes, go get their tax returns, do what you need to do on the full doc side. But while you're meeting with them, one touch is better than two. You get their bank statements. It doesn't cost you a dime to have us calculate that income for you. And you can go down both those parallel paths and then decide, let the borrower decide, does he want to go full doc or does she want to go bank statements or whatever? And then you can have those conversations up front. And as Eric mentioned very early on here, we will do pre-quals on TBDs, to be determined properties. So I think that's huge. So no one's going out shopping for a house that they don't know if they can qualify for yet. So Eric, let's talk about our marketing portal, which, we talk about serving an underutilized borrower. This is where I get a little frustrated, and I know you do too, Eric. This is an underutilized portion of our website.
Well, the term is underserved borrower, and here's the thing: how do you who are these people? How do you get to them? Well, as an originator, you want to make a ton of money. Go network with CPAs. Again, they're all sitting on a database of wealthy self-employed people that are currently crushing it, that are writing everything off, that are renting. Crazy town, USA. And literally, what is the interest rate that you're paying when you're renting? 100%. What's the interest rate that you're paying when you do a bank statement loan? It could be in the 7s to the 9s. But what is the effective rate? So
Right.
let's say that these self-employed people, let's even say in the state of California, and they're probably at a 43 to 50% tax bracket because they're writing everything off, right? So let's say the interest rate's 8%. The effective rate is only 4% with their mortgage tax deduction. Folks, it pencils out. You just got to educate. So that's our plight. We need all of us to educate this marketplace. Here's our portal. John, why don't you go to the flyers?
Yep.
So notice, let's go to the CPA flyer.
Oh, sorry, let me back up there. Sorry.
So as NMLS licensed loan officers, guys, we have to have our 8 hours of education per year to maintain our NMLS license. CPAs have to have a 2-day class every year. They usually take those classes in September and October to maintain their CPA license. But they also have to go to one quarterly meeting throughout the year. If any of you guys were to Google, I don't know, I'm in Orange County, California, Orange County Society of CPAs, you would see all of these trade groups of CPAs that go to local restaurants once every 3 months and learn about new tax code. What if you loan originators were to drop in on those meetings? You drop in not just on one, not two, but go 3 times to those meetings, become a familiar face, and now start getting all these referrals from CPAs with potential clients that want to be homeowners. Can you imagine if my CPA referred me to you for a home loan? My CPA, by the way, who knows where all my financial bodies are buried? What higher trust in finance do I have with my CPA, and he's referring me to you for my luxury home purchasing or just to even buy a house? I'm not going to contact you and just start grinding you on rate. I'm going to say, hey, my CPA, John here, says that you might be able to help me buy a house. And folks, we all know how emotional home buying is. It's not logical, it's emotional. So right here, alt income bank statement loans. Clients don't need to maximize write-off, can maximize write-offs and still become a homeowner. This is mind-blowing to CPAs. They love this because why? A CPA's favorite deduction is the mortgage tax deduction. Folks, help us get the word out.
Yeah, Eric, these are, we talk about, I said it earlier, they're underutilized. We have all these flyers. You can see we have them for foreign national bank statements, investment properties, full doc. We've got them for 1099. We have them here for you. And the beautiful thing about it is if you fill out your information for one of the flyers, it populates for all of them. I have seen people co-brand these with a realtor. I've seen people, hand these out at open houses. So they're there for you, and it's just a great. Eric, Scott, let's talk about social media. Talk about the post we have for social media.
Yep. So, and just to kind of backtrack a little bit, this is the part of this webinar where we're helping show you guys how to execute, right? Eric mentioned earlier, how many of you are actually going to take this information and apply it? This is where we're helping you execute. It's free, and we're here to help you. So if you're not taking advantage of it, shame on you in 2024. It's all here. So social media posts. You can see for every program that we offer, we have a pre-canned social media post that's geared for you to market directly to borrowers or to a realtor, to a referral source. simply copy and paste the image. You can copy paste the verbiage we've put here for you, or you can edit the verbiage, however you want to do it. Point of the matter is, want to put up a post, talk about bank statement loans today, you have resources here to do it at no cost. Copy, paste, done. You want to do it about DSCR loans, you have resources here to do it. The other one I really wanted to hop into, John, was the PowerPoint. And if you have a sec, John,
Yeah.
I emailed you a PowerPoint presentation, if you don't mind popping it open. So, and while you're looking for that, I'll kind of explain what this is. So guys, we offer a PowerPoint presentation that you can customize to present these products and programs to your referral sources, your realtor community, or it could be a group of borrowers, however you want to do it. There's also a flyer here that helps you promote that event. So you can put that flyer together, send it out to all of your realtors. Hey, we're getting together on such and such date. We're going to talk about non-warrantable condos. We're going to talk about self-employed borrowers. We're going to educate you guys on non-QM products and programs. And as your account executive, myself or Eric or any of our AEs will come and present with you as your investor, your lender, whatever you want to call us, at no cost. We're coming, we're going to talk about these products and programs because it's in all of our best interests. But as you can see here,
Scotty, I wasn't able, I have my email Outlook shut, so I wasn't able to open that one up. So sorry.
Okay, no worries. I kind of sent, what I sent you was one of my accounts, Premier Lending, good friends of mine. They took this PowerPoint presentation and they fully customized it. So if you looked at it, every single page is color coded to their colors for their organization. Every single page has their logo, their contact information on it. They did it once and they have it saved. I have probably done 13 presentations for them, with them, I should say, to referral sources, to realtors. I don't think we ever had less than 10 people in the room. They've used this flyer and this PowerPoint to promote the event and present these products and programs. And think about how powerful that is. 13 presentations last year alone. I don't think we had, again, less than 10 people in any one presentation. How many people did that company touch to be able to present these? There you go.
Hey, sorry, Scotty.
As you scroll down here, this thing is fully customized. And in the slides, they added some slides. They edited some of the information. They slid in there maybe some other products and programs that some other non-QM lenders offer, or that maybe they have on the agency side that they wanted to talk about. But the point is, this is free to you guys. It's a tool that we offer, something we are trying to help you guys add value to our relationship so you can utilize these tools to present these products and programs.
Yeah, Scott, this is powerful. So yeah, thank you for sending that. You know, Robin asked, one of the first questions we received in our question queue was Robin asking, Robin, this is the presentation. And Robin, and we'll find out who your account executive is. That account executive would go out on your behalf or via Zoom and present on your behalf, because we don't expect you to be the expert. And you guys can tell by the talent, Eric and Scott, they are experts in this. And all of our account executives across the country, they are experts. So we can do all of this on your behalf. We've done the heavy lifting for you. All you have to do is market this, market yourself, whether it's flyers, whether it's social media, whether it's whiteboard videos. We've done all that for you. And, you know, I'm going to shake my head here because it's an underutilized tool that we have that Scott can attest to this, Eric can attest to this. It's the most powerful presentation you can present to a referral source. And it's, and all of them is mine.
If I may, folks, the first step, just reach out to us. If you're not sure how to even start approaching it, that's okay. Reach out to Scott, reach out to me, and we will walk you through this. You guys, again, we're vested. We're looking for partnerships.
Yep.
And we're here to have you make money in 2024. And there's a ton of money to be made and a lot of borrowers to take care of. But just start by reaching out to us and let us show you the way.
Yep.
So, Eric, 9% of the loans we close here at Angel Oak are actually realtors. So if you get 12 realtors in a room, the odds are you're going to close one of their loans. So, and I'll even venture to guess you'll close more than one. And I know we're at the top of the hour, so I do want to give Eric, in closing, anything you want to add?
Folks, it's go time. If you want to make money, write down a financial goal and reach out to Angel Oak, and let's get there.
Scotty?
Yep. Thank you to everybody for hopping on and sharing some time with us to go over what we offer and what the industry looks like, the outlook, the forecast, and the trends for 2024. As I said earlier, I think this year presents a huge opportunity for all of us. Eric said it numerous times, we are vested. Guys, we don't get paid unless the loan closes. We are vested. So it is in our best interest to help you all share this information with your referral sources, with the community out there. Call us, schedule some presentations, schedule some events. We're more than happy to go out there on your behalf, and sharing is caring, right? Let's spread the love out there. It all starts at the realtor level. Realtors aren't selling homes. You guys don't have loans to originate. We don't have loans to close. So we're all in this together.
Yeah, very well said, Scott. Eric, a couple of other things. There is a short survey after this. Please take it. We're always looking for ways to do things better. Next week, a week from today, we are doing a deep product dive. I know a lot of people had some questions on bank statements. We're doing a deep product dive next week on bank statements. We'll talk about the 1003. We'll talk about credit. We'll talk about way more details on bank statements. And then the following week, we've got our debt service coverage ratio. So thank you for everyone. You know, let's continue to, as Eric said, it's go time. 2024 is where you're going to change your vision towards non-QM. For everyone on this call that has closed a loan with Angel Oak, we really do appreciate your business. For those have not, give us the opportunity. Obviously, you can see with the subject matter experts and the experience that we have, as Eric mentions, we will hold your, Eric mentioned, we will hold your hand for the entire process. So on behalf of everyone here at Angel Oak, thank you. Happy New Year. Eric, thank you for your time and your professionalism as always. Scotty, love working with you every day, day in, day out. Everyone have a great rest of your day, and let's look to grow your business in 2024. Thank you.
Thanks, everyone. Have a good one.
Bye-bye, guys.